A question all business owners should ask is, what is my exit strategy? A business sale might be one of the options, so let's open up our thinking and run through what it takes to prepare your business for a sale.
What agreements do I need to review or install to prepare my business for sale?
Hello, today I'm going to be talking about preparing your business for sale. I believe it's really important that you have an opportunity to prepare your business for sale and not scramble to put things in place when a knock on the shoulder happens to you. A couple of things that I think up front that we should be talking about are having a really robust shareholder agreement. The time to put a shareholder agreement in place is now, while everybody is around the table and talking to each other. You've got to be able to show that to the potential buyer that you're going to be able to deliver all shareholders into the deal. It protects you and it protects the other shareholders. The other agreements I think you need to look at in your business are your supplier agreements, your customer agreements, and your lease agreements. Your supplier agreements because you want to be able to ensure that your supply chain is robust and will continue to supply the new purchaser in the manner that you've been operating. Your customer agreements, really important that you look and see what the change of ownership clauses are in those contracts to make sure that you're able to hand those over to the new purchaser. Remember, it is your customers and the future transactions with them that the actual purchaser is buying. The other thing I think to look at is your lease agreements. A lot of businesses will own their own premises, and have we got a robust lease agreement in place that reflects a market rent? Obviously, this will need to be negotiated with the purchaser going forward. However, it's an agreement that you'll need to put in place.
Why is it important to know exactly what is being sold?
The second question I have for you is know upfront what you are selling. Are you selling the assets or are you selling the shares? There can be a huge difference. With capital gains tax laws these days, your assessable income on the capital gain could be anything from 0% to 25% to 50% or to 100% of the taxable gain. It's a huge difference, and remember, tax is a deduction from your purchase price. So it's important that you know what it is up front. Don't try to negotiate it or change mid-negotiation, and certainly no tax planning should be done post-transaction. It all needs to be done up front.
What will I sell my business for?
The third question I have for you is a really interesting one. What did you actually sell your business for? A lot of people would go to the enterprise value. My take on that is that's all about ego. My opinion, what you actually sell your business for is the dollars that you put in your pocket. That equals reality. So what is that and how is that determined? Well, your enterprise value, which is normally determined by your profits times a multiple, is the headline figure of what all the shares are worth and what the business is worth in its totality. However, it doesn't take into account deductions that need to be made from that. And you need to be across all of those deductions. The first one would be working capital. So how much working capital is going to be required to be left in the business so that the purchaser can operate it normally? What tax is going to be deducted from that enterprise value? As I said in my previous question, you need to know that up front because that is certainly a deduction from your purchase price. How much debt is in the business? The purchaser isn't going to be buying your debt. The debt is going to need to be paid out by the seller, and if it's not paid out and it's left in the business, then it's going to be a deduction from the purchase price. The other thing that you need to be aware of and that you can manage is your warranty exposure. So they are all the things that may happen to the business post the transaction that might require you to pay the purchaser or pay back the purchaser for things that haven't been disclosed to them throughout the process. So effectively reimbursing the purchaser for any losses that were unknown at that time. Once you've deducted all of these issues, then that is what you put in your pocket, and that is what I would say you've sold your business for. The important thing to note in this is that at each of those points, your working capital, your tax, your debt, and your warranty exposure, you have the opportunity to plan out and to put in place a process that effectively minimises each of those things, and that will give you the best result.